Small investors are about to get rug pulled as the stock market has been going on a monster rally, and it looks like big money is about to dump. Unload those shares on small unsuspecting investors, leave them holding the bag right before the bottom falls out beneath their feet. So we're gonna look at number one, why does it look like the stock market is facing a severe drawdown sometime very soon? And number two, what can you actually do about it? Because I would never suggest selling everything, going to cash, or YOLOing all in on a big short position on the stock market. Never suggest that, because if your investing success depends on you being right about the time and direction of the market, then you'll always lose money investing, because there are more ways you can be wrong than there are that you can be right. So at the end of the video, we're going to go over some exact things that you can do to protect yourself and prepare to profit from this. And the best part is, if we're completely wrong about this move, you can still make money. And also, after the video is over, if you've been on the fence about joining Heresy Financial University, right now is the best time to do so. This is the last chance to take advantage of the current pricing. I'm currently running a sale and the price will never be this low again. So after the video, check it out. Make sure you use code LASTCHANCE2023 to take advantage of the discount. Okay, so the stock market has been going on this monster rally, and it looks like it is about to face a severe and soon correction. So the first reason why is the VIX. We've talked about the VIX in a past video very in depth, but this right here is the VIX, which is short for Volatility Index. And you can see that basically sometimes it spikes and then it falls back down, spends the majority of its time lower, and then again, it'll spike. The Volatility Index is calculated by looking at the money options on the S&P 500. When those options that are at the money options get really expensive, that's the market anticipating a higher likelihood of the market moving up or down. And so the volatility index will go up. But if the market is not anticipating a high likelihood of the market moving in any direction, then those options will be very cheap, which means the VIX will go down. The way that volatility works is that the longer volatility is low and the lower level it gets to, the higher the likelihood is that we'll have a spike in volatility at some point soon. Zooming in on the recent chart of the VIX here, we can see that the VIX is extremely suppressed. In fact, the last time that it was this low was prior to 2020. And it also just so happens that right now there is a huge amount of money betting against volatility spiking. And the way that those trades work, since they use derivatives, if volatility does start to move up, then they all have to be unwound, which itself causes volatility to spike even more. And when volatility spikes, that means the stock market is dropping. So based on historical measures of volatility in the stock market, we are experiencing an almost unprecedented level of low volatility, which means we should expect at least a reversion to the mean, a return to normalcy, a spike in the VIX, which would indicate at least some sort of a small drawdown in the stock market. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. And they're straightforward about how they keep your assets separate and safe. And if you use my my link in the description below, you will get $100 worth of Bitcoin just for signing up. The next indicator that we're going to be looking at is RSI, or Relative Strength Index. At the bottom of the chart here, I'm going to pull it up. You'll see a purple chart, and this is Relative Strength Index. Relative Strength Index is something you can look at on any asset like the stock market overall or any individual stock. And it simply is a measure of whether something looks overbought or oversold based on its recent price action. Anything in between these levels on RSI, 70 and 30, is considered normal. If it's in here, it's not considered overbought or oversold. But anytime RSI exceeds 70 or is below 30, it's going to be considered overbought on the upside and oversold on the bottom side. You can see that right now RSI is at 82. By historical measures, an RSI of 82 is extremely overbought. And as we're going to look at here, when it gets into overbought territory, that indicates a sell-off soon. The last time the S&P 500 was overbought was July of 2023. You can see right here that resulted in a downside move of 10%. The time before that, where RSI exceeded 70, was June of 2023, and you can see during that time frame it resulted in a sell-off of only 2 to 3%. Now the next one was August of 2022, and we can see that that one resulted in a drawdown of 19% of the stock market. And the time before that, where RSI exceeded 70, was November of 2021, and we can see that that resulted in a monster crash of 22% in the stock market. Now there's no real correlation between how overbought something is and the extent of the sell-off that happens afterwards. As you can see right here, this is a monster level of overbought at 82. The last time we saw that was September of 2020, and the sell-off that we got then was only 10 to 11%, which is half of what we saw during this sell-off and about half of what we saw during this sell-off. But there is a pretty high correlation between when something becomes overbought, there is at least a small correction, and sometimes even enter into bear market territory. The next thing we're looking at is that the S&P 500 is looking at a double top right now. Back in January of 2022, the S&P 500 reached an all-time high of about 48.15. As of the time of this recording, the S&P 500 is closing in on that at 47.62. If instead we look at a weekly chart where each candlestick represents an entire week, we can see that we are pretty close to closing in on resistance here. And it looks the same way when we look at the S&P 500 with a monthly chart. Again, we're right at resistance here. The next indicator we're going to look at is something called Bollinger Bands. Now, these lines might look like a mess to you, but first I want you to just focus on the outside lines that are blue. There's one on the top, and then there's always one on the bottom. Those bands represent one standard deviation point of movement in the underlying asset, which means that it is uncommon, though not impossible, for the price to actually hit that band. And the longer it stays touching that band, the more likely it is that you'd see a pullback. It's been riding the upper band since November of 2023. And the last time that it spent a significant amount of time riding the upper band ended in July of 2023, which resulted in, again, a 10% sell-off in the stock market. And I get it for those of you who just hate technical analysis and think it's all voodoo, even though it's simply just a visual representation of group behavior, that buying and selling action that results in the consensus price, where you can visually see the patterns that emerge out of that group behavior. I've got something for you as well. This is the Fear and Greed Index. I'm sure every single one of you knows the Warren Buffett adage that says, buy when others are fearful and sell when others are greedy. And right now, the market action is showing extreme greed. When broken down into its components, we can see that the market momentum is showing extreme greed. Stock price strength is showing extreme greed. Breadth is showing extreme greed. Put and call options are showing extreme greed. Market volatility is actually neutral. Demand for safe haven assets is only at the level of greed. And then junk bond demand is only at the level of greed, bringing us to an aggregate score of 80 out of 100, which is on average in extreme greed territory. Now, I need to reiterate, I am not recommending anybody sell all their positions. I have never, and I would never tell anybody to sell it all, go to cash, sit on the sidelines and wait for this thing to crash, because at the end of the day, none of us have a crystal ball. And so I'd rather invest in a way where I can profit regardless of whether or not I'm right. Unsophisticated investors lose money all the time by jumping on trends right at the last moment before the tide turns, not bailing fast enough. Their small losses turn into large losses. They have no risk management, and also they ignore position sizing rules. And so they took a far too big position in the first place, and so that large loss ends up devastating their portfolio. Instead, we do things smart around here. So number one, always make sure you keep your position sizes appropriate compared to your portfolio. Don't look at your positions in dollar amounts, look at them in percentage amounts compared to your portfolio. Number two, always maintain your core positions because the likelihood you're wrong is always bigger than the likelihood you're right. Number three, hedge your portfolio or at least your vulnerable positions just in case you are right. You can either choose a little bit more of an expensive hedge so that you are invulnerable to really any drop in your portfolio value, or you can choose a cheaper hedge that will allow your portfolio some volatility, but in the case of an extreme sell-off, you profit. And then finally, take many small asymmetric bets. For instance, we just looked at put and call options being in extreme greed territory. Puts are extremely cheap right now. Nobody is buying them. Everybody is betting on stocks only going up and volatility only staying low. This is an opportunity to bet against the consensus, and you probably won't be right, but in the case you are, those profits are meaningful. Don't bet the farm, very small bets, where if you lose a little, and if you win big. You can do this on individual securities that you believe are more vulnerable in the case of a market correction, or you can do this on the market overall. And of course, if you'd like help learning how to do that, that's why I run Heresy Financial University. Link is below. Make sure you sign up before the end of the year using code LASTCHANCE2023 to get your pricing locked in at this low. It'll never be this price again. As always, thanks so much for watching. Have a great day.